Futures and options are inherently risky and not suitable for all investors. Only risk capital should be used. An investor may lose more than the original investment. Past performance is not necessarily indicative of future results.
Hey everybody, it's Matt. It is Wednesday, the 16th of May, just about 11:45 here now. We're doing Trading Talk Wednesday this week rather than Thursday, as I'll be doing some traveling the next couple days. So right now we got the bonds for June trading at 146.14 and trading 145.24 on the set. Now, in last week's video, I talked about some levels I was watching yield-wise, and that was 3% in the long bond and 1.80 in the 10s. And both of those levels were, in fact, breached. I was dead wrong on this one, and when I'm dead wrong, it's time to start getting out and trying to shed some risk. So that's really been the name of the game the last couple days. Now, looking at this market action, obviously everybody's feeling very jittery about what's going on in Greece. There's a lot of risk in the market, and the calls are really starting to get bid up in the bonds and notes. Now, before we get into a play here, as always, remember that if you're going to do some trading, you should only be doing trading with risk capital, and by that I mean money that you can afford to lose. This type of stuff is not suitable for everybody, okay? If you're trading futures or writing naked options, you can lose more than your initial investment, and your potential losses can be unlimited. So you really want to make sure you know what you're doing before getting into something like this, and also make sure it's appropriate in light of your financial circumstances. So that being said, right now I just think there's a lot of risk out there, and I'm more comfortable kind of standing on the sidelines as much as possible right now and taking a wait and see. I like my sleep at night, and it's just not worth worrying about. That being said, if you are somebody a little bit more on the aggressive side and you want to try and take advantage of these calls really being bid up right now in the bonds, one potential trade I did look at was selling the July 150-154 call spread in the bonds. Now on that, you're going to look to collect 30 ticks or better, so you're talking about $468, not including commissions and fees. You do want to remember that because it's a spread, there will be two sets of commissions and fees. But the nice thing about this trade is it's a limited risk trade, okay? Because it's a 4-point spread, you can't lose more than 4 points, which in the bonds is $4,000, minus the premium you've collected, okay, $468 approximately. And then you also want to factor in your transaction costs there. So it is a limited risk position that can give you a way to potentially sell this pumped up premium in the calls. Now, those options have 38 days until expiration, and obviously, with that short of a window, if we do start seeing some selling in the bonds and notes, we see the S&P starting to rally, or we see a resolution out of Greece that is looked at favorably by the market, we could see the bonds take a decent slide relatively quickly, in which case, with only 5 weeks or so to go, they should start killing the values on those July call options rather quickly. So that's one way you can play it if you really want to be in this market right now. As always, remember money management and risk control, okay? Good luck. I hope it's helpful, and we'll see you next week.